Hello and welcome back to this YouTube channel. As you could see it here that it is the 11th discussion regarding the current affairs of Indian economy. You know, if you are the continuous visitor of this channel, then you could see that we had already completed for the polity and governance and international relations. Now, one more thing which I have to say you guys, that from the 1st of July we are going to make it properly, we are going to make it proper institution kind of thing here, in which we are going to take the static portion, then daily current analysis, and every day we will take the quiz session in which at least 10 to 15 questions would be discussed, which would be based on the previous year question papers, based on the current affairs going on, and the static portion which we discuss based on that. So my request to you guys is, please do stay with me, do subscribe this channel. you know it would benefit you if you are planning to uh, you know crack the prelims exam, or you are planning to crack the UPSC exam or any state JKPSC or any PSC exam. Then you should stay with me. It would be very helpful for you guys. And please do subscribe to this channel. Your subscription, when you subscribe, it motivates me, and that gives me an energy by which I would be happy to bring the much better information to you guys. So one more thing which I want to say you guys, that the this it is not the time to discuss the concepts that in that detail, but we would take up, and my the motive of this these videos is to bring you the most information to which would be helpful for you guys. And one more thing, from the 1st of July, the medium of these lectures might be mixture of Hindi and English, so don't worry. And you can write in the comments in which language do you want us to bring the information. Now, without wasting any time, let's discuss the topic of today's lecture. First, we have to discuss the National Multidimensional Poverty Index. About multidimensional poverty, we had already discussed it in our one of the previous lectures. So I would like to repeat usually what happens, how we calculate the poverty. It is basically on usually based on the income and expenditure of a household or of a person. We define poverty on that criteria only, but due to the recent changes in the understanding of the economy and other things, we reached to the conclusion that only the income does not define the it should not be the defining criteria. Only the personal income or household income, it should not be the defining criteria of the poverty. There are many dimensions to it, like how what is the education, what is the dropout rate, how is the health, and all other stuff which are correlated to it. So bring all these dimensions into one definition that we call multidimensional poverty. So with regarding to that National Multidimensional Poverty Index, we have Niti Aayog released a discussion paper related to national dimensional poverty in India since 2005 to 6. So in this report, we would see where do we stand in the table, what are the things which our government should, what are the policies which our government should follow, so execute, so that most of the people will come out of it. About multidimensional poverty, it refers to a measure that considers various factors, as I already told you, different dimensions beyond the income to assess and understand poverty. And also, multidimensional poverty encompasses the various deprivation experienced by poor people in their daily lives, such as poor health, lack of education, inadequate living standards, poor quality of work, the threat of violence, among others. Also, ending poverty in all its form, everywhere. The aim of Sustainable Development Goal (SDG 1) entails viewing poverty not solely in relation to income and consumption, but as relating to other multiple capabilities. So from this, as we already discussed it, we don't have to take only the income criteria of a household. We have to look at different dimensions also to check the poverty, like poor health, lack of education, inadequate living standards, poor quality of work, and threat to the violence. And also about Sustainable Development Goal 1, in which we don't have to just solely you know concentrate on the income and consumption, but other related aspects, as we discussed already. Moving forward, what are the measurement of the multidimensional poverty? Here we could see that the multidimensional poverty index assesses poverty at the individual level. Alkire-Foster method is most often used to compute MPIs. About this Alkire-Foster method, we will discuss in another slide. Then we have Global Multidimensional Poverty Index, or GMPI. It is a global recognized comprehensive measure that captures a poverty in multi dimensions beyond monetary aspects. Monetary aspects, liquid assets, or usually beyond the income, or we can say money in the hand. यूजुअली हम कैसे एक इंसान को गरीब समझते हैं कि जो हमारा एक बेसिक कंसेप्ट है गरीबी का, कि किनके पास कितना पैसा है। इसके इस पैसे के अलावा के अलावा और भी बाकी सारी चीज़ें हैं विच वी हैव टू टेक इनटू द कंसिडरेशन। So this is what Global Multidimensional Poverty Index does. GMPI report was first released by the Oxford Poverty and Human Development Initiative and the United Nations Development Program since 2010. So this multidimensional poverty, it is very often in the news. If you could see the videos of our PM, he was asked the question. Actually, he was asked a question about the poor money, or we may say economic inequality. Such questions may be asked here. Global multidimensional poverty index, we should know that who framed it. Who released it? It was first released by the Oxford Poverty and Human Development Initiative (OPHI) and the United Nations Development Program since 2010. And also we could see here that it covers 100 developing countries and captures the acute deprivation in health, education, living standards that a person faces simultaneously. If a person is deprived in a one-third or more of 10 weighted indicators, the GMPI identifies them as MPI poor. Then we have National Multidimensional Poverty Index. It retains the 10 original indicators of the global MPI model. There are 10 indicators to the global MPI model. So this national MPI, these 10 models are retained in that, and has added two characters which are maternal health and bank account, in line with the India's national priorities. MPI value is arrived at by multiplying the head count and the intensity of poverty, reflecting both the share of people in poverty and the degree to which they are deprived. About head count, it indicates proportion of multidimensionally poor in the population. About intensity of poverty, it indicates average proportion of deprivations which is experienced by multidimensionally poor individuals. Under the government's Global Indices for Reforms and Growth initiative, Niti Aayog is the nodal agency for MPI, and Global Indices for Reforms and Growth monitors India's performance on various important social and economic parameters. And we should also know that the Niti Aayog uses a National Family Health Care Survey to measure the NMPI. The latest NMPI, National Multidimensional Poverty, a progress review 2023, is based on the data of National Family Health Survey 4 and 5, which is Niti Aayog National Multidimensional Poverty. This data is based on National Family Health Survey 5 and 6. Based on that survey, this data is given. About the Alkire-Foster method, can show both the breadth, incidence, and depth intensity of poverty. To identify the poor, the Alkire-Foster method counts the overlapping or simultaneous deprivations that a person or household experience in different indicators of poverty. What are the key findings of the recent discussion paper? We could see that the decline in MP headcount ratio decreased from 29.17% in 2013-14 to 11.28% in 2022-23. So there is a decline from 2013, and also 24.82 crore Indians escaped multidimensional poverty in the last 9 years. That is tremendous. And also intensity of poverty is also declining, which shows that extent of deprivation among the deprived population is falling. The pace of decline in poverty head count ratio was much faster between 2015 to 19 compared to 2005 to 16. Also, poverty declining across indicators. All 12 indicators of MPI have recorded significant improvement. Cooking fuel and housing have the highest deprivation level of deprivation, and child and adolescent mortality, electricity and bank account have the lowest deprivation levels. And also regional decline in MP. Poorer states record faster decline in poverty, indicating reduction in disparities. For example, Uttar Pradesh, Bihar, Madhya Pradesh, Odisha, and Rajasthan saw faster reduction in the proportion of multidimensional poor. And attainment of SDG. India on track to achieve SDG target 1.2, reducing multidimensional poverty by at least half, much ahead of 2030. About NMPI by Niti Aayog, we have dimensions health and education here. In next slide, we have other. In health, we have nutrition, child and adolescent mortality, and antenatal care. In nutrition, we have household is considered deprived if any child from 0 to 59 months, or woman 15 to 49 years, or man 15 to 54 years, for whom nutritional information is available, is found to be undernourished. And for child and adolescent mortality, a child and adolescent under 18 years of age has died in the family in the 5 year period preceding the survey. And about antenatal care, a household is deprived if any woman in the household who has given birth in the last 5 years preceding the survey has not received at least 4 antenatal care visits for the most recent birth, or has not received assistance from trained skilled medical personnel during the most recent childbirth. About education, we have years of schooling. Not even one member of the household aged 10 years or older has completed 6 years of schooling. School attendance: any school aged child is not attending school up to the age at which she would complete class 8. Then standard of living, we have cooking fuel here. A household cooks with dung, agriculture, crops, shrubs, wood, charcoal or coal. Sanitation: the household has unimproved or no sanitation facility, or it is improved but shared with other households. Then we have in drinking water: the household does not have access to improved drinking water, or safe drinking water is at least a 30-minute walk from home. Then in electricity, the household has no electricity. In housing, the household has inadequate housing. The floor is made of natural materials, or the roof or wall are made of rudimentary materials. About assets: the household does not own more than one of these assets, that is radio, TV, telephone, computers, animal cart, bicycle, motorbike or refrigerator, and does not own a car or truck. About bank account: no household member has a bank account or a post office account. Now, moving to our next topic, it is Unified Payment Interface (UPI). Why it was in news? We could see that the Reserve Bank of India, they had announced new rules and regulations to enhance the scope of Unified Payments Interface. About the new rules enhancing UPI transaction limit: the transaction limit for UPI payments made to hospitals and education institutes has been hiked to rupees 5 lakh from 1 lakh earlier. Earlier it was 1 lakh, now it has hiked to 5 lakh for hospitals and educational institutions. Transaction limit for UPI is capped at rupees 1 lakh, except in a few categories like capital market, broking, mutual funds, etc. Collection, credit card payments, loan repayment, EMI, insurance, etc., where transaction limit is rupees 2 lakh. Increased e-mandates for recurring online transaction limits for execution of e-mandate without Additional factor of authentication increased from rupees 15,000 to rupees 1 lakh for credit card bill payments, mutual fund subscriptions, and insurance premiums. About unified interface UPI and its features, UPI powers multiple banks accounts into a single mobile application of any participating bank, merging several banking features, for example, transfer of funds, etc. It was developed by NPCI in 2016 and built over immediate payment services infrastructure. It is the most successful real-time payment system globally, providing simplicity, safety, and security in person-to-person and person-to-merchant transactions in India. Its new features of UPI credit line on UPI, it enables pre-sanctioned credit lines from banks via UPI. Earlier, only the deposited amount could be transacted through the UPI system. About UPI Lite X, users can both send and receive money offline through any compatible device that supports near field communication. UPI Tap and Pay, it allows NFC enabled QR codes at merchants to complete payments with a single tap without entering the PIN. About conversation methods, conversational payments, Hello UPI. Users can simply give voice commands to transfer funds and input a UPI PIN to complete the transaction. Then bill pay connect. Customers can fetch and pay their bill by sending a simple hi message or by giving a missed call. Other proposed changes for UPI payments we have deactivate UPI IDs. National Payments Corporation of India (NPCI) has asked banks and mobile payment applications like Google Pay etc. to deactivate UPI IDs and numbers of accounts that have been inactive for 1 year. The 4-hour time limit for users initiating first payments over rupees 2,000 to new recipients make UPI transactions safe. This has added a layer of control and security as it allows users to reverse or modify transactions within that window. And also introduction of UPI ATMs allowing cash withdrawal by scanning a QR code. Initiatives to promote UPI. We have UPI for a secondary market introduced by NPCI to enhance the ease of equity trading in country. UPI challenge campaign launched by NPCI to promote UPI as an easy, safe, and instant mode of payments. It also educates users about various features such as UPI Lite that enables swift, low-value transactions. Memorandum of Understanding between Google India Digital Services and NPCI International Payments to broaden use of UPI payments, enabling travelers to make transactions abroad and ease remittances process between countries. India's UPI in overseas markets, various countries like Oman, UAE, France, Nepal, Bhutan, etc. are using UPI system for payment. UPI 123 Pay, it is an instant payment system for future phone users who can use UPI payment service in a safe and secure manner. These are the benefits of UPI for merchants: low cost of acceptance, accept payments without credit debit cards, eliminates need to return or handle cash change, suitable for both physical and online merchants, facilitate access to credit for customers around the check availability, single app for accessing different bank accounts, multiple use cases for various kinds of payments, able to raise complaints from mobile apps directly, and convenience and ease to use. For banks, low investment towards branch and POS, low cost of merchant onboarding and transaction data for better understanding of customers to uplift cross-selling, upselling. For fintechs, PSPs, open architecture to promote innovative products, collaboration with FIs for customer-centric solutions, possibility to market innovation create products. Now, third topic of our today's discussion is non-performing assets. These are those assets on which either the interest amount or the principal amount is not paid from the last 3 months or 90 days. So let's discuss about it. RBI's annual trend and progress of banking in India report for the financial year 2022-23 showed that the gross non-performing assets ratio fell to 3.9% in 2022-23. As we know that a non-performing asset refers to a classification for loans or advances of a bank that are in default or arrears. A loan is an arrear when principal or interest payment are late or missed, and become a non-performing asset when the interest or installment of principal remains overdue for more than 90 days. GNPAs are the sum of all loan assets that are classified as NPAs. Reasons for non-performing assets: we have defective lending process, improper selection and lack of periodic review of the credit profile of borrowers. Ensuring their repayment capabilities can create NPAs in PSBs. Due to lack of cooperation with financial institutions, borrowers default in more than one bank. Willful defaults arise in cases of borrowers who have access to funds to repay their loans but still choose not to and default on the payment of the loan. Then we have industrial sickness, ineffective management, lack of adequate resource and technological changes, and changing government policies produce industrial sickness. Therefore, banks financing these industries ultimately end up with a low recovery rate of loans, reducing their profit and liquidity. About regulatory floating of RBI guidelines and non-compliance with the regulatory directions regarding banking operations by police sector banks by public sector banks can lead to frauds and rise in NPAs. Frauds by banker and borrower: the size of fraud in the public sector banking system has been increasing though still small relative to the overall volume of NPAs. In the first half of the 23-24 financial year, there is an increase in reporting of fraud cases in the banking sector to 14,483 from 5,396 cases in the same period a year ago. Now, impact associated with non-performing assets: we have economic growth risk. Rising NPAs prevent banks from lending for other productive activities, leading to a slowdown in economic activity. It can further lead to a decrease in employment opportunities and inflation. We have higher interest rates. Increasing NPAs can lead to an increase in interest rates to cover the losses, which can lead to an increase in borrowing costs for individuals and companies. We have public trust. Rising NPAs led to reputational, operational, and business risk for banks and undermined customers' trust with financial stability implication. We have pendency. The courts are facing the problem of increasing pendency of cases as the current setup of courts made the deal with the problem of debt recovery is not efficient and does not have enough manpower available to deal with the high influx of debt recovery cases. Then we have capital adequacy issue. NPAs erode the capital base of banks. When NPAs increase, banks may struggle to meet capital adequacy norms. Steps taken to reduce NPAs: we have SARFAESI Act, which is Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. It allows secured creditors to take possession of collateral against which a loan had been provided upon a default in repayment. Then we have debt recovery tribunals established under the Recovery of Debts and Bankruptcy Act 1993, provide for the establishment of tribunals for expeditious adjudication and recovery of debts. Then we have Insolvency and Bankruptcy Code (IBC) 2016 for the organization and insolvency resolution of corporate persons, partnership firms, and individuals in a time-bound manner, that is within 180 days or the extended period of 90 days. Then we have National Assets Construction Company (NRCL). It aims to reduce NPAs of banks, improving financial system stability and efficiency. It is incorporated under Companies Act 2013 with PSBs holding a majority stake. Then we have Indradhanush plan for revamping PSBs, envisaging infusion of capital in PSB. About NPAs classification: we have substandard assets, we have doubtful assets, and we have loss assets. In substandard assets, we have NPAs for a period less than or equal to 12 months. Then in doubtful assets, we have remained in the substandard category for more than 12 months. Then assets, loss and had been identified by the company or by the internal or external authority or by RBI, but the amount had not been written off wholly. Other highlights of reports on trend and progress of banking in India 2022-23. We could see here that the consolidated balance sheet of SCBs grew by 12.2% in 2022-23, the highest in 9 years. Then also in 2022-23, the combined balance sheet of urban cooperative banks expanded by 2.3%, while that of non-banking financial companies expanded by 14.8%. The rate of growth of the unsecured retail segments has outpaced the total bank credit growth. NBFC's double-digit credit growth was driven by the growth of unsecured loans, which grew more than twice as fast as secured loans. During 22-23, the total amount of fraud reported by the banks declined to a 6-year low, while the average amount involved in fraud was the lowest in a decade. And also, the capital to risk weighted ratio, assets ratio of SCBs reached 16.8% at the end of September 2023. Concerns raised by the report we have long tenure by the report we have long tenure of directors, absence of comprehensive risk management policy, and deficient compliance culture in UCBs. Then we have concentration risks of corporate credit in NBFCs and significant exposure of banks to NBFCs. The top 50 exposures of government-owned NBFCs constituted about 40% of the total corporate credit within the NBFC sector. Also, all these 50 exposures were the power sector, which faces multiple inherent issues. About G securities, it is the next topic. Recently, these are the government securities. Recently, the Reserve Bank of India has permitted the lending and borrowing of G securities by issuing directions called RBI Government Securities Lending Directions 2023. Government securities lending refers to lending of eligible G-SECs for a fee by the owner lender to a borrower on collateral of other G securities for a specified period under the government securities lending transaction. G-SECs issued by the central government, excluding treasury bills, shall be eligible for lending and borrowing. Also, securities issued by the central government, including treasury bills and state government bonds, shall be eligible for placing as collateral under GSL transactions. State governments don't issue treasury bills, they only issue the bonds. Other directions include eligible participants in GSL transactions as lenders of securities and titles eligible to undertake repo transaction and those approved by RBI. Tenure of a GSL transaction minimum 1 day and maximum period prescribed to cover short sales. Permitting lending and borrowing of G-SECs will add depth and liquidity to the G-SEC market, aiding efficient price discovery, and also facilitate wider participation in the securities lending market by providing investors an avenue to deploy idle securities and enhance portfolio returns. Enhance operational efficiency of government bonds by insurers. About G securities, G6 is a tradable instrument issued by central or state government. It acknowledges the government's debt obligations. Such securities are short terms, usually called treasury bills, with maturities of less than 1 year, 91 days, 182 days, and 364 days, or long term government bonds or dated securities with maturity of 1 year or more between 5 years and 40 years. In India, central government issues both treasury bills and bonds or data securities, while state government issue only bonds or data securities, which are called state development loans. G-SECs carry practically no risk of default and hence are called risk-free gilt-edged instruments. Other G-SECs include cash management bills introduced in 2010, a short-term instrument to meet temporary cash flow mismatches of the government. CMBs have the generic character of treasury bills but are issued for maturities of less than 91 days. Also, G-SECs are issued through auctions conducted by RBI. Auctions are conducted on the electronic platform called the eKuber, the core banking solution platforms of RBI. Benefits of GSEC: we have low risk investment since they are backed by government, stable source of income as they offer fixed interest rate. Securities such as state development loans and special securities, oil bonds, Uday bonds, etc. provide attractive yields. Then we have integrating G6 in a diversified investment portfolio can help reduce overall risk easily tradable in market, which means that investors can buy and sell them quickly, use it as collateral to borrow funds in the repo market. Great news, state government guarantees, SGGs. Reserve Bank of India released the report of the working group on the state government guarantees in 2022 32nd Conference of State Finance Secretariat discussed problems of inadequate monitoring and reporting of guarantees issued by the state governments. As a response, a working group was formed to address this issue. About state government guarantees, a guarantee is a form of contingent liability designed to shield investors or lenders from the potential default risk of a borrower. State governments often authorize and issue guarantees on behalf of the state enterprises, cooperative institutions, urban local bodies, and other state owned entities. These guarantees are typically extended to lenders, commonly commercial banks or other financial institutions concerned with SDGs. Fiscal risk, we have guarantees can pose fiscal risk, straining state finances with unanticipated cash outflow and increased debt. We have prudential level of debt GSDP for a state is 20%, but non-disclosure of a high guarantee level understands states debt to GSDP. We have moral hazard guarantees could create moral hazard, leading to the guaranteed entity to be suboptimal in performing its obligations. Similarly, investors and lenders may be less motivated to thoroughly assess project compared to the traditional non-resource project financing. Recommendations by RBI report, we have clearly defined purpose for which government guarantees are issued, charge a minimum fee for guarantees extended, fix a ceiling for incremental guarantee issued during a year at 5% of revenue receipts or 0.5% of GSDP, whichever is less. Then states should continue to build up the guarantee redemption fund or GRF established to cushion liabilities due to innovation of guarantees. Then we have participation from the states in GRF is voluntary. 19 states have already established GRF. Now, moving to the next discussion, we have petroleum exploration and production. Oil and Natural Gas Corporation has started first crude oil production from its Cluster 2 deep sea project in the Krishna Godavari basin in the Bay of Bengal. About petroleum basin in India, a petroleum basin includes a diverse collection of rocks and sediments. Both, most importantly, it contains source rocks. Source rocks are a specific shale formation in basin where oil and gas are born. There are 26 sedimentary basins in India, covering a total area of 3.4 million square kilometers. Of the total sedimentary area, 49% of total area is located on land, 12% in shallow water up to 400-meter deep water depth, and 39% in the deep water area further up to exclusive economic zone, which is up to 200 nautical miles from the coastline. The jurisdiction of EEZ extends 200 nautical miles from the coastline, thereby conferring on the coastal state the right to manage, explore, exploit, and conserve all resources within its purview, be they living or non-living. These basins are also divided into three categories based on the maturity of hydrocarbon resources as under category 1 commercially established and producing basin, total 7 basins. Category 2 we have prospectivity identified, total 5 basins: Kutch, Mahanadi, northeast coast region of Andaman Nicobar, Vindhyan, Saurashtra. Then category 3 prospective, total 14 basins. We have Himalayan foreland, Ganga, Kerala to Konkan to Lakshadweep, Bengal, uh, Kareva, Spiti, Zanskar, Satpura to south, Reva, Damodar, Narmada, Deccan, Siniculis, Bhima, Kaladgi, uh, Sudapha, uh, Pranhita to Godavari and Bastar, Chhattisgarh. Then methods of extraction of crude oil, we have offshore drilling in marine environments, offshore basin like Arabian Sea or Bay of Bengal, onshore drilling on land covering various sedimentary basins across the. This is the India sedimentary basin. You could see that in this map. This Krishna Godavari region in Rajasthan, Mumbai offshore, Nepal. These are the categories. You can please take the screenshot shot of it, and you can recap it. And category one, it is mentioned here. This Mumbai offshore area. Here we have the category one, and in the northeastern area, and here also Krishna Godavari area. Then in category two we have Kombe area. This here we can see these are the areas we can directly find it here from reading the map. Now steps taken for enhancing petroleum. We have Directorate General of Hydrocarbons was formed to promote sound management of the oil and natural gas resources. Approval process have been streamlined by digitalization and standardization contractual of submissions on the e-platform. Then we have National Data Repository launched for public in 2017, serves as a government data bank promoting E&P activities. And then upgrade of NDR to a cloud-based state-of-the-art facility with the virtual data room is in progress for investors for 24/7 access to E&P data. Then, as per the India Hydrocarbon Vision 2025, lays the broad contours targets for development of hydrocarbons, 100% automatic FDI through route for exploration activities of oil and natural gas fields, infrastructure related to marketing of petroleum products and natural gas, etc. Then we have National Seismic Program aims to undertake a fresh appraisal in all sedimentary basins across India. About see that hydrocarbons commonly occur in sedimentary basin and are absent from intervening areas of igneous and metamorphic rocks. A sedimentary basin is an area of the Earth's crust that is underlain by a thick sequence of sedimentary rocks. About this data, third largest India is third largest energy and oil consumer in the world. 33% share of oil and gas in India primarily energy, and 85.7% was the import dependency of oil, while for natural gas it was 48.2%. Significance of indigenous petroleum exploration and production. We have reduction in import bill as India imports about 85% of its crude oil requirements. Indigenous petroleum production will reduce trade deficit and strategic importance, reduce vulnerable to geopolitical uncertainties, supply disruptions and price fluctuations in the global market. And revenue generation. Indigenous petroleum production contributes to government exchequers through taxes, royalties, and profit sharing agreements. Employment generation. Jobs across a range of activities, including exploration, production, refining, and distribution. About help introduction in introduced in 2016, replaced a new exploration license policy, provides for a single license for E&P for all types of hydrocarbons, conventional oil and gas, CBM, share oil, gas hydrates, etc. Shifted from the previous profit sharing model to a revenue sharing contract model. Revenue is shared between the government and the contractor. In profit sharing model, the profit was shared after cost recovery. OALP was introduced to enable investors to select blocks of their choice by evaluating data in the NDR and expressing interest, reduced royalty rates, marketing and pricing freedom, round the year bidding, etc. Then unconventional petroleum resources, oil and natural gas trapped in less permeable rocks is referred to as an unconventional resource because it cannot be explored, developed and produced by conventional process. Conventional resources, it is a term referring to oil and natural gas trapped in rock that is porous and permeable. The natural pressure of the underground rock formation allows oil and natural gas to flow freely up as petroleum well. These include deposits like coal bed methane or coal seam gas, refers to methane-rich gas naturally in coal seams, typically comprising 80% to 90% methane with a lower proportion of ethane, propane, nitrogen, and carbon dioxide. Then we have shale gas or oil. It is a form of natural gas oil that remain unexpelled, unmigrated, and entrapped within the porous space and fractures of a source rock, commonly shale. The shale gas or oil is produced commercially when sufficient fracture conductivity is induced by a hydraulic fracturing. Gas hydrates, these are naturally occurring ice-like solid clathrates in which water molecules trap gas molecules in deep sea sediments and in and below the permafrost soils of the polar region. Now, the next topic is food processing industry. India's processed food exports has grown by 150% in the last 9 years, making agricultural exports touch a value of about 53 billion. What is food processing? Food processing is the set of methods and techniques which are used to transform raw ingredients into finished and semi-finished products. According to Ministry of Food Processing Industry, if any raw product of agriculture, animal husbandry or fisheries is transformed in such a way that its original physical properties undergo a change, the transformed product is edible and has commercial value, then it comes with the domain of food processing industry. Benefits of food processing: we have reduction in waste or as a processing helps in extension of shelf life. Nutritional benefits include addition of particular vitamins through fortification methods tailored to specific dietary needs. It can address the malnutrition and nutrition among children as well as overpopulation. Enhanced employment by generation of additional jobs in various segments of logistics, trading, etc. Rural development, increased exports and demand of processed food worldwide can benefit farmers by improving their income, leading to rural development, poverty reduction, and etc. Adoption of new and emerging technologies for processing improves efficiency in this sunrise sector. Exports can lead to foreign exchange earnings, improving India's trade balance and economic growth. First, in India, we are first in dairy production, second in horticultural crops. Average annual growth rate of 8.3% in the last 5 years, and 22.6% contribution in agri-food exports in 2021-22. Institutions measured agriculture and processed food products export development authority has been established as per APEDA Act 1985 for development of export by providing financial assistance, fixing of standards, improving packaging. Then we have the Marine Products Export Development Authority. It is a statutory body entrusted with the primary task of promotion of export of marine products. Then we have India Institute of Packaging, develops standards for export packaging fruits and vegetables. And we have Export Inspection Council, is the official export certification body having global acceptance which ensures quality and safety of products exported. Then we have Agriculture Export Policy 2018 has been introduced with the objectives of doubling India's share in world agri-exports by integrating with global value chain. Initiatives taken by the government: we have Pradhan Mantri Kisan Sampada Yojana. It is a central sector scheme for development of mega food parks, integrated cold chain and value addition infrastructure, food safety and quality assurance infrastructure, etc. Then we have Pradhan Mantri Formalization of Micro Food Processing Enterprise Scheme, PMFME scheme, aims at upgradation of micro food processing units, providing seed capital of SHGs and branding and marketing support. One district, one product component of PM FME aims to create specific product clusters, and we have production linked incentive scheme for food processing industry is a central sector scheme to support creation of global food manufacturing campaigns and support Indian brands in the international market. Then we have liberalized FDI regime, 100% FDI through automatic route for FPI and 100% FDI through government approved route for retail trading, including through e-commerce. Then we have Krishi Udan and Krishi Rail schemes have been launched to ease out freight rates, enabling smooth movement of perishables. Now, the last topic of today's discussion is Pradhan Mantri Gram Sadak Yojana. A parliamentary panel has asked the Union Rural Development Ministry to tighten the supervision of road construction in rural areas under the Pradhan Mantri Gram Sadak Yojana, indicating the use of poor quality materials. About Pradhan Mantri Gram Sadak Yojana, it started as 100% centrally sponsored scheme launched in the year 2000 to provide all weather rural road connectivity to eligible rural habitations. It comes under the Ministry of Rural Development. It's eligible for the population greater than 500 in plain areas and greater than 250 in hilly areas and other difficult areas. Funding pattern to this is the funding pattern was revised to 60-40 ratio between center and state in 2015-16 and 90-10 ratio for northeastern states and Himalayan states. The scheme has four verticals: PMG SY1 2 road connectivity project for left-wing extremism areas and PM3. For PMGSY1, it was launched in 2000. It was launched to provide rural connectivity by way of a single all-weathered road to the eligible habitations as per census 2001. For PMGSY2, it was launched in 2013. It was launched with a target to upgrade 50 km in various states and union territories. Then road connectivity project for left-wing extremism affected areas. 2016 it was launched for construction and upgradation of strategic important roads, mainly to improve their road connectivity in left-wing extremism affected districts and adjoining areas. Then PMGSY3 launched in 2019. It was launched for consolidation of 1,25,000 kilometers to connect major rural links connecting habitations inter area to gram agriculture markets, higher secondary schools and hospitals.